Hey guys, how are you?
Hi, Rufus. How are you?
I'm a little under the weather, but I'm doing
Oh
good.
no. Are we in a conference right now before we let everyone else in, or is everyone being left in? Just so I know.
Um,
Meaning,
we should be. Let me look. No, we're open.
let's
Sorry, sorry about that. So, Rian, are you ready? Okay, I just want to make sure. I'm going to go ahead and introduce myself and Rian here, and hopefully we'll have some additional participants join us in just a moment. My name is Rufus Guidry. I'm the Senior Manager of Community and Business Development with InTouch Credit Union. We're glad to have you guys here with us in our first to last, I guess, or second to last webinar of the year. Rihanna will be hosting both of those today and next week. For those of you that have been participating, these have been very educational throughout the year, and we could not have had a better partner to educate our members and answer all our questions with their retirement this year. So one, I wanted to thank you for that and being a great partner. Without further ado, I'm going to do an introduction, and then we'll turn it over to Rian. So Rian is the CEO of Silver, which provides members like you with retirement calculators, tools, and education through Retirement Simplified. Prior to founding Silver, Rian worked for 17 years at JP Morgan, where she advised individuals and families on investments, credit, and wealth planning. We're excited to have her, as always, with us today to help you learn about the tax updates and tips that will help you optimize your 2023 tax return. So, Rian, I'm going to turn it over to you.
All right. Thank you, Rufus, for welcoming us here today, and for all the InTouch Credit Union members on the line. Thank you for taking this time. I know it's a busy time between lots of holidays. Today is Giving Tuesday. Yesterday was Cyber Monday. So appreciate you taking some time to really think about your own wallet and how we make sure that more of your hard-earned savings stays with you than goes to Uncle Sam. As Rufus has mentioned, Silver is really focused on helping members like you navigate retirement. And today we're going to spend some time just diving into some year-end tax tips, things that you can do between now and year-end, just to try to keep a little bit extra cash in your pocket. I will say before we kick off that there's the devil's in the details always when it comes to taxes. And so I want you to know that after the session today, you can feel free to create your profile at Retirement Simplified at this URL, which is itcu.silver.com. Everything I'm talking about is there. So I don't want you to feel overwhelmed that you need to take lots of notes. Just know that we actually have classes, and we'll talk a little bit more about what we do, but all that information will be on the web and easy for you to access afterwards. Second thing I just wanted to flag is that neither myself nor Silver are tax professionals. And so really what I'm here to do is just provide you with some guidance on some kind of, I would say, well-known planning strategies. But we're going to do a couple things. The first is we're going to have space for questions. And so I would encourage you just to use the Q&A button to type in your questions so we can answer them. Typically, we'll hold those until the end, but try to get them in early so we can make sure we get your answers. And secondly, if there's something we can't answer today, Rufus and I will follow up with you and our team, just really make sure that we're getting you the information that you need. But we're going to really try to cover what we think are the main topics that are relevant for most folks. Again, keeping this at kind of that level. So as Rufus mentioned, sorry, looks like my screen may be frozen. Let me just give me 1 second to see if we can move it forward. Okay, hold on. It looks like we started at the end of the deck rather than the beginning. So give me 1 second to get back to the beginning. So let me just give you a quick introduction on Silver, and so that we have a little bit of context on kind of why we're having this conversation. So our goal at Silver, as Rufus mentioned, is to really help members that are getting close to retirement or in the early stages of retirement, navigate the big decisions that you make around retirement, whether it be Medicare, Social Security, spending, where you live, and taxes. At the heart of what we do is we make sure that every member can answer the number one question that's on many members' mind, which is, do I have enough savings left to last a lifetime in retirement? We do that through our retirement score, which helps you understand how long your savings will last, and helps you understand how decisions like when you retire, whether you work part-time in retirement, where you live, how all of those things impact the longevity of your savings. Obviously, taxes is a large part of understanding how long your savings are going to last. Depending on where you live, your savings may last a longer period of time. So today we're going to focus in on one of our new classes, which is the 2023 end of year tax tips class. I would just say that in the experience, we also have classes on Medicare, Social Security, cost of living, inflation, and more. All of this is intended to be easy reads. What I don't want to be providing you is a long white paper that feels overwhelming to get through. Everything that we deliver are kind of 3 to 5 minute reads. And so the goal is just to make this easy to access, get answers to your questions so that you can get back to doing the things you love in life, which probably isn't thinking about taxes. So a couple of the topics that we're going to run through today, we're going to talk about just making sure you max out your contributions before year end. For those of you that are over the age of 72, we're going to talk about required minimum distributions. We'll talk about Roth conversions, a concept called tax loss harvesting, which you can do at year end, gifts and charitable donations, and then finally we'll walk through a healthcare checklist. So let's talk about what's new. So as you think about where we are this year, we are talking about planning your 2023 tax return, which you will file in the spring of 2024. So the numbers we're going to talk about will be the numbers that are affiliated with your 2023 tax return. As we go into that process, what you'll notice is we're going to be talking about increased tax brackets, changes in how much you can contribute to your 401k, as well as increases in your health saving plan limits. Many of these numbers were adjusted last year by the IRS as part of the annual inflation adjustment that the government does. So you may be familiar with the inflation adjustment that comes from Social Security, which is the annual cost of living adjustment. For those of you that are enrolled in Medicare, you likely are seeing, inflation adjustments rolling through your Medicare premiums, and that typically means a higher cost. The one place the government can give back to you is through the inflation adjustments that are actually made by the IRS, and that's things like increasing the federal tax brackets along with inflation. It may be credits and deductions increasing, again, to account for kind of inflation. So typically what we see is these numbers change every year. And so we're going to run through some of those numbers just to make sure that as you're doing kind of your end of year planning, that you're capturing like the latest numbers that impact your 2023 tax return. I will tell you that the government has already announced the numbers for 2024. So we also in the experience have all the information for 2024. So as you move from planning for your 23 tax return to start to think about 2024, all that data is in the experience. All right, so tax brackets, let's just start there. And I just picked one tax rate. Obviously, members on the phone are going to have different income tax. And so the rate that you'll specifically be subject to will not only be based on what your earnings are, but also where you live. What I just pulled in here was the federal tax brackets for the 22% tax rate for single individuals, as well as for married couples that are filing jointly. And what you'll see here is that while the rates have not changed, so the tax rate of 22% did not change, what did change was the bracket that it applies to. And so you'll see, for example, for members that are single, that the 2022 tax bracket applied to members with $41,776 to $89,000 and $75 in income in 2022, and those brackets all bumped up by $2,950 in 2023. And so on the upper end of that bracket, it allows you to earn a little bit more at a lower tax rate, but you can see that all those brackets have moved up both at the single and the married level. So that's one thing that particularly as you're filing your tax returns, whether you're doing it with an accountant or with an automated tax platform, what you'll notice is that those brackets have changed, and that will be automatically calculated as part of your tax return. Some of the things that I think are important to think about as we kind of go into the final weeks of the year, if you're in a position where you're able to max out a 401k, I just want to flag that 401k contributions that you're able to contribute $22,500 for the calendar year 2023. That's a $2,000 increase from calendar year 2022. If you're over the age of 50, you also have the ability to make a $7,500 catch-up contribution in 2023, and that's a $1,000 increase from 2022. So again, this is just one example of how the government is doing an inflation adjustment to give you a little bit more space to put more money away for retirement if you have that ability. So on the IRA side, IRA contributions also have increased. And so on the IRA side, we've seen the IRA contributions increase from $6,000 to $6,500, and IRA catch-up contributions actually have stayed flat. And so just if you have an IRA that you're contributing to, just want to flag that you have an extra $500 that you're able to contribute in 2023. All right, one thing just to keep in mind is that for those of you that are retired, you are still able to make contributions to a traditional IRA or a Roth IRA. So depending on your income situation and whether maybe you're working part-time, there is that ability to still contribute to these retirement savings plans. So let's talk about RMDs. So required minimum distributions. For those of you that have IRAs and 401ks, what you'll know is that you have the ability to put tax-deferred savings into these accounts on an annual basis. But at a certain point in time, the government says that you need to start taking money out of those accounts. And so the required minimum distribution is the amount that the IRS says you must start taking out of a 401k or an IRA every year, after a certain age. It's always based on the December 31 balance. So when you think about taking an RMD out of an account for this tax year, it's based on the 12/31/22 balance. So it used to be that the RMD age was 70 and a half, and then it bumped up to 72. The new RMD age is age 73, and by 2025, the RMD age is 75. So what this means is that by 2025, members will be able to keep their retirement savings in those accounts until the age of 75 before the government starts to require that you take money out of the accounts. A couple things I would just flag on RMDs. The first thing is that the percentage that you have to take out of the account changes every year. It starts at about 4.5%, but there's a new percentage that you have to calculate every year. The second thing is that if you are married, you must still take RMDs out of both members' accounts. So if both members are over the age of 75, for example, in 2025, the key thing here is that you can't take your RMDs all out of one partner's account, but not take it out of the other account, because the government does not allow you to merge your IRAs with a spouse, or does not allow you to merge your 401ks with a spouse. So just kind of flagging that in advance so that you're aware of that. The second thing also is that unless you and your spouse are the same age, you will actually have different percentages that you have to take out of the account. And so it's really important that you calculate these numbers individually, rather than thinking about it as like a household number. It may be that ultimately there's a household RMD, like a cash amount that you're thinking about, but you'll actually have to do the calculation on an account by account basis. A couple things that folks think about who are in a position where perhaps they don't need all those RMDs to fund their retirement savings. One thing that you can do is you can donate funds directly from your IRA to a qualified charity. It's a really elegant way of making a charitable donation in retirement. And if you make a direct donation from the IRA to the qualified charity, it doesn't become a taxable event. So this is a scenario where instead of giving cash to a charity, you use some of your RMDs to have it donated directly to the qualified charity. Your investment advisor can make sure that that transaction happens in a way that really follows the IRS rules, because the most important thing if you're doing that is that you can't receive a check. The money has to go directly from your IRA to the qualified charity. The second way to reduce RMDs is to convert your IRA or your 401k to a Roth. And there are many factors that go into deciding whether a Roth conversion makes sense. But I do flag that for folks that want to decide when they take money out of their retirement savings, rather than being told by the government that they must take money out of their savings, that one of the benefits of a Roth IRA is that Roth IRAs are actually not subject to RMDs. And so if you have a Roth today, the good news is you don't have to worry about RMDs. But for folks that perhaps have large RMDs and are considering Roth conversions, this can be a benefit to considering that Roth conversion. So let's talk about the deadlines. So the deadlines for this year is, so withdrawals for RMDs need to be made by 12/31. And again, the balances are based on your 12/31/22 account balances. So if you're like many members who have likely seen a rise in their accounts over the course of this year. Just remember that you're not taking the funds out based on the end of this year's balance. The actual percentages you withdraw are based on the withdrawals, on the balances that you saw last year, December 31st, 2022. All right, why do I spend so much time talking about this? Well, the government wants to make sure they get paid. And the way they do that is they have some pretty bad penalties that they charge if you don't actually pay your RMDs. So I guess the slightly good news is the penalties have actually been reduced in the last year or two. It used to be that there was a 50% excise tax if you didn't pay your RMDs. That's been reduced to 25%. But that fine is both applied to either late RMDs or miscalculated RMDs. So that's a pretty significant fine that, frankly, I would hope no member has to pay, because that's a lot of money to be handing over to the government for this specific rule. And so the reason I've spent a few minutes talking about RMDs here is just making sure everyone's aware of it, because I definitely don't want anyone to be subject to these excise taxes. All right, so let's talk about tax loss harvesting basics. So, we talk a little bit about ways to think about kind of managing your portfolio as we go into the end of the year. And one of those is tax loss harvesting. Tax loss harvesting is a way to take losses on positions that you've had during the calendar year to help offset gains that you have in your portfolio. It could be capital gains, it could be ordinary income, it could also be taxes from a Roth conversion. So for tax loss harvesting, the first thing to think about is that the concept of tax loss harvesting only applies to actual taxable accounts. So that means it does not apply to accounts like 401ks and Roths. The key thing to be aware of is that if you are selling shares at year end to help offset gains that you have in your account, it's really important that you don't just sell the stock and buy that stock back a day later. So what the government says is that there's this concept called wash sales, which basically says, look, if you're going to recognize a loss, you have to wait 30 days before you repurchase what's called a substantially similar security. That 30 days is actually a window before and after. So it ends up being basically a window of about 61 days, 30 days before you sell your stock and 30 days afterwards, that the government says, look, if this is really going to be recognized as a loss, then you need to actually stay out of that stock position for a specific number of days. So again, really just keep in mind that if you are doing that tax loss harvesting, once you sell, you then have to wait a period of time before you purchase. So this year, if I think about the tax loss harvesting key dates, the first thing I would think about is the last day that you can sell shares that you plan to repurchase in 2023 is actually this week. The deadline is November 30th. The last day to sell shares and just recognize losses for 2023 is 12/31, so the end of this year. So it could be that you're not planning on repurchasing, and so you don't need to worry about the November 30th deadline. If all you're planning to do is sell some shares and recognize some losses to help offset some gains you have in your portfolio or to offset some income, then you can do that all the way up to December 31st, 2023, and have those losses available to use in your 2023 tax return. All right, let's talk about gifts and charitable donations. It is Giving Tuesday today. And so as we think about, ways that you think about making donations, some of you may be thinking about making charitable donations to charities. And again, this is the conversation that we started a few minutes ago where we talked about donating directly from your IRA and making sure that that donation happens directly so that it's not a taxable event. The other thing that you can do there is you can basically use your RMD as a way to make that donation. Second thing is just gifts to family members. Gifts to family members in 2023 can be $17,000 per person. This is not a tax deduction. So just to be clear there is not a tax deduction. But it may be, a way, again, that you're thinking about kind of lowering taxes over time. When you think about gifts, they do add up against your annual, it adds up against your lifetime exclusion. So just thinking again about like how might you use that lifetime exclusion to donate to family members, that if you're a married individual, a couple can donate twice that amount. And so if you're married, you could give up to $34,000 to a family member and have that count as a non-taxed gift. Dollars above that, will be subject to gift tax. But again, cash below that, our $17,000 is not a taxable event. All right, let's talk about a healthcare checklist. And then I realized that we skipped over Roth conversion, so I'm gonna just talk about those for a few minutes at the end before we wrap up. So on the healthcare side, there's a couple different types of healthcare accounts that for those of you that are working, you might have. One is called an FSA, flexible spending account. These funds are typically offered by your employer. They are what are often called use it or lose it savings plans. And so that means that if you don't use it in the calendar year, that the cash is not available to you the prior year. So if your plan ends on 12/31/2023, you typically have until 3/15, so March 15th, 2024, until you can spend your FSA funds. And actually, sorry, that should be April 15th, 2024, that you can spend your FSA money. One thing I would just say is that you should check with that your employer allows for the exception, because there are some situations where a employer does not allow for an extension. And so you need to be mindful of what that extension date is. Different to an FSA is an HSA. So HSA are health savings accounts, and these are accounts that you can fund yourself if you are currently in a high deductible plan. In 2023, individuals were able to put $3,850 in an HSA, and families were eligible to put $7,750 in an HSA. HSAs, I think, are one of the, I would say, savings plans that are probably the least well-known and least utilized of the health and retirement savings programs that are out there. And I would just double tap on this, that for folks that are getting close to retirement, one of the things to really think about is, what the role of an HSA can be in retirement. And so what's really elegant about an HSA is not only are you contributing pre-tax money to an HSA, the savings are allowed to grow tax-free, but in retirement, when you withdraw the money and use it for healthcare purposes, there's also tax-free distributions. And so this is a really elegant type of account. Unfortunately, many retirees do face out-of-pocket costs in retirement, even when they're on Medicare. And so this account type is one that is particularly advantageous for members to utilize during retirement. All right, so before we go to the key dates, I want to just go back for a second and talk about Roth conversions. It looks like the slides did not make it into the deck, so let me just maybe talk a few minutes about Roth conversions, and then we'll go to some of the key dates that you need to keep in mind. So several members on this phone may be thinking about Roth conversions, and this is when you take a traditional IRA and you convert it into a Roth IRA. There are many fact patterns that go into determining whether or not a Roth conversion makes sense for you. The starting point to think about is that this is often what's called a backdoor Roth. It is the ability to convert that IRA to a Roth, which is outside of what the traditional income limitations are for a Roth account. It often makes sense for folks to think about Roth conversions when, for a couple of reasons. One is that they don't want to have to deal with RMDs, and so they want to be able to get their account into an account type that isn't subject to RMDs. It may be from an estate planning perspective that you want a child to inherit a Roth account rather than a IRA. It used to be that there were huge estate planning advantages to Roths because they could be held on for a long time by the next generation, but that actually has been shut down by the IRS. And so now beneficiaries do have to spend down their Roth after 10 years, so that isn't this like open-ended kind of tax benefit. When you look at your particular position, typically folks have thought about Roth conversions when they have an account that perhaps has some losses in it, and they have the ability to do the conversion without paying a high tax fee or high taxable I guess, kind of income on the day that they make the conversion. When you do make a conversion, any gains in the account are treated as an income distribution. And so the thing to be really mindful of if you're considering a Roth conversion is the year that you do a Roth conversion, it could significantly bump up your income. That could mean that it changes your income tax rate for the year that you do the conversion. For those of you that perhaps are on Medicare already, it could also trigger what's called IRMAA, which is the Medicare surcharge, because again, the conversion triggers income tax. So I would just say that there are some very interesting benefits to Roth conversions around the ability to take funds out tax-free later on in life, the ability to give an account to a beneficiary and allow them to hold that tax-free distribution for a period of time, as well as the ability to avoid required minimum distributions. That being said, for those of you that are either in the 2 years leading into Medicare, so up to 60, so let's call it between 63 and 65 or 65 and above, I would caution you that a Roth conversion can trigger income that will impact your Medicare costs. And so this is one where I would encourage you to sit down with your financial planner and your accountant to really really check and see whether that Roth conversion makes sense for you. All right, so I'm just going to pause for a second. I know we've got a couple of different questions that are coming in, and so we're going to answer them in a second. But if you have questions, please let us know. Let me just go through some of the key dates, and then we'll take it from there. So a couple dates to remember. We've talked about a couple of these as we've been going through the session today. So the first is November 30th, 2023. And this, just to be mindful of, is where the tax loss harvesting comes into place. The deadline for November 30th is for you, the last day that you can sell shares that you plan to repurchase in 2023. On December 31st, 2023, we have 3 deadlines to be aware of. The first is at the RMDs. The deadline is December 31st, 2023. So you must withdraw your money by that date. The second is that if you're doing any tax loss harvesting, December 31st, 2023 is the date that you need to sell all stocks and recognize gains in 2023. And then finally, December 31st, 2023 is the deadline for 401k contributions. So if we move forward to the new year, April 15th, 2024 is the date that the IRA contribution limits are required by. And so that's the date that you need to make your contributions. HSA contribution deadlines are also April 15th, 2024. And then finally, the FSA deadline for spending is typically April 15th, 2024. I would just flag that you do need to check your with your employer to make sure that they don't have a different deadline. All right, so Rufus, that was the main topics that we're going to cover today. I think we've got a bunch of questions that we can start answering. And so why don't I pass it over to you to pull them up?
Okay, sounds good. So our first question is the 401k contribution max for all versus each one I may have?
Okay, so to answer this first question, it is a max contribution across all of your accounts. So there is not a difference. If you have, for example, 2 employers, you can't contribute that amount to each 401k. It's an aggregate. Most individuals typically only have one 401k that they're still contributing to, which would be your current employer. Typically, you're not able to contribute to a prior employer's 401k.
Okay. Our next question is the catch-up amount for 401k in addition to or part of the max contribution?
Yeah, so that's a really good question. So the catch-up is an additional amount. So the idea behind the catch-up is that this is one tax break that the government is giving members that are over the age of 50. The concept is to catch up. So perhaps you weren't able to continue to contribute on a regular basis to your 401k. This is the ability to add an additional $7,500, so that an additional $7,500 on top of the 401k, the original 401k amount. So that means that I'm just kind of adding up the total. So if you're over the age of 50, that you have the ability to contribute $30,000 to a 401k in 2023.
Okay. Our next question is, I missed the benefit advantage related to an RMD. What is a Roth conversion in this case?
Yeah. Okay, so required minimum distributions, the government says that any IRA or 401k that you have starting at a certain age that you are forced to make distributions from it. Basically, the government is saying you cannot keep that money in a tax deferred account forever. And so that's the starting point. But that RMD requirement is only for accounts, include tax deferred accounts like IRAs and 401ks. It does not apply to Roth accounts. So when I was walking through what a Roth conversion might look like, one of the comments I made was that a Roth conversion, oftentimes folks like the idea of a Roth conversion because a Roth conversion is not subject to RMDs. So again, RMDs really apply to tax deferred accounts like 401ks and IRAs. RMDs are not applicable to Roth accounts.
Okay, and the last question in the deck. So if anybody has any other questions, please provide them in the Q&A. But please provide an example on how gifts lower taxes.
Yeah. So the idea behind the annual exclusion on the gifts is that if you use the annual exclusion, it is not subject to gift tax. So if you decide to give a family member $30,000, then the amount over that $17,000 is actually subject to taxes. So one of the ways that you think about reducing taxes is if you, for example, want to help a family member buy a house, which would be like I know my own father helped one of my siblings do that. The better way to structure that is, instead of giving them $30,000 in 1 year, is to spread that out over 2 years. Because if you spread it out over 2 years, then it's a non-taxable gift. If you give it all in 1 year, then the amount over $17,000 is subject to gift tax. And so that is the thing to keep in mind. And again, I see another things like a follow-up question, which is on the gift. There's no real benefit to the giver. The tax benefit is to the receiver. The tax on, and sorry, let me just think about this for a second, but the tax on the gift is actually the taxation is actually to the donor, not the receiver. And so this is where you need to be careful with how you're structuring that gift. All right, I think we had a couple more questions, Rufus, that maybe were submitted in advance. And so I just want to check those again. And the first was, can you explain about the RMD calculations? Are they the same for my spouse and I? And just to double tap here, I think one of the confusions about RMDs is often that relates to spouses, which is you have to calculate the RMDs on every single account. And the RMD calculation is actually based on your age. So for example, if you are 75 and your spouse is 70, you owe RMDs on your accounts, but not your spouse's accounts. But once both of you have hit that RMD age, then you both are subject to RMDs, but the percentage that you take out of your account is based on your age. So the percent you take out at 73 is different than the amount you take out at 75. And that's where just, again, getting those calculations correct is important. The second is, so when does a Roth conversion make sense? And we talked a bit about that, which is the Roth conversion makes the most sense when you're really thinking about how to control your RMDs, when you're thinking about perhaps giving an account to a beneficiary and wanting them to get a tax-free account. And it also is a point of view that you think that perhaps your taxes are going to be higher sometime in the future than they are today. When you do that, often folks will do Roth conversions in the early years of retirement. Perhaps you've retired, but aren't receiving Social Security yet. And so you have these windows where perhaps you have a lower income tax rate, and you'll do a Roth conversion because the tax level will be lower then versus when perhaps your Social Security starts in the future. And then the last question I saw kind of submitted in advance, Rufus, was just around moving. And I think the one thing I would just flag for everyone as you're thinking about year-end planning is that if you've moved this year or you're thinking about moving next year, just really take the time to really understand, what the taxes look like in the new state that you're living in. Everything I've talked about here has really been at the federal tax level. But obviously, depending on what state you're living in, you may also be paying local state taxes. Keep in mind that every state is going to have specific requirements on what qualifies as domicile. And so really understanding, does your state have a day count that you need to be aware of so that you understand which state you're actually paying your state taxes in. All right. So I think we have another question about gifts. Do you want to take that question,
Yes.
Rufus?
Can we go back to gifts? If I give my sister 12,000 this year and it's my only gift, I, as the giver, have no tax benefit, correct? My sister does not have to report it as taxable income, correct?
Yeah, so that's good question. So again, you were able to give your sister $12,000 this year and it not be deemed to be subject to gift tax. So I guess that I would say that there is a tax benefit because there's no gift tax, but you're able to give $12,000 without any tax consequences is the way to think about it. So there's not subject to tax. And again, your sister does not have to report it as taxable income because it's all within that tax threshold. Again, the tax threshold for the year is $17,000, so you're well within that threshold.
And they said, thank you, they've got it now. So thanks for being very thorough.
Yeah, so I know devil's in the details, so thank you for all the extra questions. A couple things I would just say to kind of wrap us up. Again, the goal here is to try to answer some questions to make sure you keep your hard-earned savings in your pocket rather than Uncle Sam's. As you kind of think about big things as you transition from 23 to 24, a couple things I would think about. The first is that Roth conversions can be attractive in current markets. Just taking a look at your accounts, seeing whether you have any accounts where there may be losses. And particularly if there are losses in those retirement accounts, you may be able to do a Roth conversion without paying as much taxes. Just again, be really mindful if that you're doing that and you're age 63 and above about the implications on your Medicare bill. And again, I say this from personal experience because I know my own father has triggered IRMAA through Roth conversions, and it's just something to be really mindful of. Other things that trigger IRMAA will be selling a home. So if you're thinking about selling a home, and you're also thinking about a Roth conversion, really important to think about the sequencing of it may actually make sense to do all of it in 1 year rather than doing it over different years. Second is HSAs. For anyone that's on Medicare today, I think you'd probably agree with me that one of the most frustrating parts of Medicare is the amount of out-of-pocket costs that you may still be paying. And so for anyone that's under the age of 65, would just encourage you that if you have the capability to contribute to an HSA, it can be a really tax advantage account in retirement. And then finally, moving in retirement can be a big decision. I know a couple of the members on the phone today live in states like Texas and Nevada that have pretty attractive state taxes. But really just understanding how taxes and where you live impacts your retirement is going to be really important as you move from kind of tactical planning just for this tax return to thinking about longer term planning. As we went through this conversation today, I spent a lot of time focusing on the 2023 tax return. We're obviously moving into 2024. And so what I wanted just to flag for you is that as you think about transitioning into 2024, we have lots more information in Retirement Simplified to help guide you through these decisions. So whether it's really understanding some of the tax filing decisions you need to make for retirement, learning how Social Security is taxed, understanding, how to navigate market downturns and what the tax tips might be, understanding how where you live impacts your taxes. And then if you're like many Americans, you probably have retirement savings in different type of accounts, whether it's Roths or 403Bs or 401Ks. So really trying to understand how each of the accounts you have is taxed. There's a lot of information here, but what I would just say is that we've really tried to make the information easy to access. These lessons are all kind of 1 to 6 or 7 minutes long. They're written, you can start and take a break and then come back in and finish it up. So the goal is really to get you the information that you need, so that, you know, you can live your best retirement. Again, everything we've gone through today is in our year-end tax tips class. So again, I know we had a lot of numbers that were thrown out there and a lot of good questions, but wanted to say that after this session today, if you log on to itcu.silver.com, it's a free member benefit. You can create a profile, get personalized retirement recommendations, and then all of the information that we shared today, you can find in that class. And so that's what I have today, Rufus. I don't know if there's anything else we want to talk about just to wrap up.
Yeah,
Other
so
than
I would
wishing
just,
everyone happy holidays.
yeah, I want to also remind them that we do have one more webinar coming up next week. It is the 2024 annual updates with Social Security, Medicare, and ACA. So that email went out to our members this morning. So hopefully those of you that are on here have gotten that email and have registered. We look forward to our last webinar of the year and starting the new year off with a whole new set. But we appreciate everyone today on today's call. Ryan, as always, thank you for spending the time with our members. I know they appreciate it very much, and you answering their questions.
All right. Thank you very much, Rufus. And again, for all the In Touch Credit Union members, thank you for joining us today. Any follow-up questions, I know Rufus and the team are available, or you can also reach out via itcu.silver.com, and we're happy to answer any further questions that you have.
Thank you.
Thank you very
You guys
much.
have a good afternoon.